Is your money just sitting in a savings account, losing a fight against inflation? You think you are playing it safe, but what if I told you that not investing is the biggest financial risk you can take? Let's be real, the stock market can feel like walking into a casino blindfolded, but the real gamble is letting fear dictate your financial future. Today we are smashing the 8 psychological piggy banks holding you back from building wealth. First up, the big one, loss aversion. This is that gut-wrenching feeling you get when you lose $20, which hurts way more than the joy you get from finding $20. It is science. Psychologists have found that the pain of a loss is twice as powerful as the pleasure of an equal gain. This makes us terrified of seeing our portfolio dip, even for a day. The fix? Think long-term. Historically, the market trends up. You are not day trading, you are building wealth over decades. Set up automatic investments. This way, you invest consistently without having to stare at the scary red numbers and make an emotional decision. It is like setting your financial diet on autopilot. Next, we have the herding mentality. Remember that time everyone was buying up meme stocks like they were the last roll of toilet paper in 2020? That is herding. We see a crowd running in one direction and our brain screams, "They must know something I do not." So we jump in, often right at the peak, just before the price plummets. It is basic survival instinct, but in investing, the herd is often stampeding off a cliff. How do you break free? Do your own research. Seriously. Understand what you are investing in. Is it a solid company with real earnings or just a rocket ship fueled by internet hype? Your portfolio should reflect your goals and research, not a trending hashtag. Barrier number 3 is overconfidence. Oh, this one is fun. This is the "I picked the last 3 winning stocks. I am basically Warren Buffett" syndrome. Early success can be dangerous. It makes us believe we have a magic touch, leading us to take bigger, dumber risks. You start ignoring diversification because you are so sure your next pick is the one. It is like winning a poker hand and then going all in on the next one with a terrible hand. The antidote is humility. Acknowledge that you cannot predict the future. Diversify your portfolio across different asset classes. This is not admitting defeat, it is smart risk management. Even the real Warren Buffett diversifies. Are you better than Buffett? I did not think so. Now for its evil twin, analysis paralysis. This is when you have 50 browser tabs open, comparing every ETF, reading every analyst report, and watching every YouTube video until your brain turns to mush. You are so overwhelmed by information and the fear of making the wrong choice that you end up making no choice at all. And guess what? Doing nothing is a choice. A choice to let inflation eat your money for lunch. The solution? Keep it simple. You do not need to be an expert to start. Pick a low-cost, broad market index fund like one that tracks the S&P 500. It is a fantastic diversified starting point. You can get fancier later. Just start. Perfection is the enemy of progress and, in this case, the enemy of profit. Let's talk about confirmation bias. This is our brain's tendency to actively seek out information that confirms what we already believe. If you think a certain tech company is the future, you will only read articles and watch videos that praise it, while conveniently ignoring the reports about its shaky finances. It is like being in an echo chamber of your own making. To combat this, play devil's advocate. For every piece of positive news you find about a potential investment, actively search for the opposite view. Look for the bear case. What are the risks? What could go wrong? This balanced approach helps you make a decision based on reality, not just your personal fan fiction. Next is the recency bias. This is when we give way too much weight to recent events. If the market just had a fantastic year, we assume it will keep going up forever. If it just crashed, we are convinced it is the end of the world and will never recover. Our short-term memory hijacks our long-term perspective. Think about it. People who sold everything in panic during the 2020 crash missed out on one of the fastest recoveries in history. How to fix this? Zoom out. Look at market charts over 20, 30, or even 50 years. You will see that crashes and corrections are a normal, recurring part of the journey. They are not the end of the story. They are just a dramatic chapter. Barrier 7. The endowment effect. This is our weird tendency to overvalue something simply because we own it. That stock you bought that has done absolutely nothing for 3 years, you hold on to it because it is your stock. Selling it would feel like admitting you made a mistake. It is like that ugly sweater your aunt gave you that you will never wear but cannot bring yourself to throw away. The solution here is to conduct regular portfolio checkups. Ask yourself, if I had the cash equivalent of this stock today, would I buy it? If the answer is no, it is probably time to sell and move that money to a better opportunity. Be ruthless. Your portfolio is a business, not a museum of past decisions. Finally, the most insidious of them all. Instant gratification. We live in a world of same-day delivery and on-demand everything. We want results now. Investing is the complete opposite. It is a slow, boring process. It is about planting a tree, not microwaving a burrito. The desire for quick wins can lead us to speculative, high-risk bets instead of sound, long-term strategies. The trick is to reframe your mindset. Celebrate the process, not just the outcome. Get excited about hitting your monthly investment goal. Create a visual representation of your progress, a chart, a spreadsheet that shows your wealth slowly but surely growing. This makes the long journey feel more rewarding. So, there you have it. Loss aversion, herding, overconfidence, analysis paralysis, confirmation bias, recency bias, the endowment effect, and the need for instant gratification. These are not just investing problems. They are human problems. But recognizing them is the first step to conquering them. Start small, automate your investments, diversify, do your homework, and most importantly, play the long game. Your future self will thank you for it. If you found this helpful and are ready to stop letting your brain sabotage your bank account, hit that like button and subscribe for more content that makes sense of money. Thanks for watching, and I will see you in the next video.